Hey everybody, it's time for this month's installment of the 5 stocks I'm adding in my portfolio. This is August 2023, so I'm going to be adding 5 stocks to my portfolio when I make my monthly round of stock buying. 3 of them are positions I'm adding to, and 2 are brand new positions to my portfolio. So let's start with the stocks I'm adding to. One of my favorite stocks that I haven't added to in a long time is Dreamfinders Homes. Ticker symbol is DFH. First of all, head over to their investor relations page. The CEO just put up his annual letter. It is a great read. It's one of my favorite CEO letters. And just to kind of run down some of the highlights, Dreamfinders is one of the few businesses that not only is founder led, but the founder has a very controlling stake in the business. He owns 65% of the stock. Over 99% of his net worth is tied up in the company. A lot of skin in the game that is very, very rare, even among founder CEOs. Uh, Dreamfinders, if you're not familiar, uses an asset light home building model, meaning that they don't buy any land until they actually have a house under construction. The conditions in the market are just very strong for home builders right now. There is not a lot of existing home inventory on the market. Makes sense because people have 3% mortgage rates and don't want to give those up. So people aren't choosing to sell their homes. So the market is really in favor of home builders right now, which can be a little more flexible when it comes to controlling inventory. In 2022, Dreamfinders was a highly profitable business despite the real estate market really slowing down in the second half of the year. Trades for less than 10 times its 2022 earnings, even after the recent rally. The company closed on just under 7,000 homes in 2022. It is a very profitable home builder. To show you what that land light model does, its return on equity is historically over 40%. It was 49% in 2022. Generated record cash flow in the second half of the year, like I said, despite the market slowing down. And it's using it to really deleverage its balance sheet. That's a big, big priority going forward. One of investors and my biggest concerns with Dreamfinders is that it has a lot of debt relative to its peers. Right now, it has about a 43% debt to capitalization to market cap ratio. The goal is to reduce that to 20% over the next 5 years. The CEO said in his letter that they're seeing supply chains continue to normalize from all those pandemic disruptions, which are still working its way through the system. And as the supply chain normalizes, the cycle times are going down, meaning the time it takes the company to construct and deliver a home, which is a very good thing. So even though Dreamfinders has rallied quite a bit, I'm still planning to buy more. Another one, and I'll keep this one short because I talked about this last month, Brookfield Corporation, ticker symbol is BN. I've been building a position for some time, and I want my position in Brookfield to be much, much larger. And one of the biggest things I like about Brookfield right now is that it trades for a discount to the sum of its parts. Just to kind of run down what Brookfield owns, they own a lot of big stakes in publicly traded companies that have their name on it. They own 75% of Brookfield Asset Management, which is BAM, 48% of Brookfield Renewable Partners, which is BEP, 27% of Brookfield Infrastructure Partners, which is BIP, 65% of Brookfield Business Partners, which is BBU. They have a stake in Brookfield Reinsurance, which is BNRE. And it also owns a huge real estate operation that it took private in 2021. At the time, it had a valuation of over $18 billion, and that valuation has more than likely increased since then. We all know what's happened to real estate since 2021. It has its insurance solutions business, and it trades for a discount to when you add all that stuff together. It trades for a nice discount. Management has been buying shares pretty aggressively since in 2023, and there's just lots of room to grow throughout this business. So not only is it at a discount, but it has a great history of delivering for shareholders, and I have no reason to believe that will change. Okay, number 3 of the stocks that I'm adding to, already one of my largest positions, but I'm adding shares of GM, General Motors. I think it's really an underappreciated play on the electric vehicle revolution. The company's recent earnings, they beat on both the top and bottom line. Supply chains are normalizing, just like in the home building space. Supply chain issues in the auto space were a big factor over the past couple of years, so that's what drove revenue higher by 25%. GM raised its guidance across the board, increased its cost-cutting plan, and it is really in the process of ramping up its EV capabilities. Delivered 50,000 EVs in the first half, expects to deliver about double that in the second half, There's some big launches coming up in the second half. It's targeting $50 billion in just EV revenue by 2025. And at that point, it wants to have a capacity of 1 million EV units in North America. The charging collaboration with Tesla should make it easier to mass produce and kind of build out their infrastructure and make their products a little more appealing. The Cruise automotive or autonomous driving division, the progress has been better than even I expected. They've already completed 3 million driverless miles. They're making 10,000 rides per week. If you aren't familiar, they are offering paid rides in certain places around the US. And the recent data is pretty impressive. 54% fewer collisions under same conditions as opposed to human drivers. So GM's projections or their goals by 2030 are to double revenue and expand their margins to 12 to 14%. If the company can successfully do that, it would mean about $38 billion of annual net income at the midpoint. The current market cap is just about $55 billion. So a lot of potential if GM can deliver on its ambitious plans. So those are the three that I plan to add to this month. New positions. Number one, brand new to my portfolio, Truist Financial, TFC. We all know this bank. It formed from the merger of BB&T and SunTrust. It's the next largest bank outside of the big four in the U.S. It's technically a regional bank, but it is a very big institution, $574 billion of assets, has about 2,100 branches in 17 states, mostly in the Southeast. So if you're not in the Southeast, maybe you aren't too familiar with Truist. They have a healthy deposit base. Over half of 57% of their deposits are FDIC insured. The stock is still down significantly because of the regional banking headwinds that we saw earlier this year. It has rebounded somewhat, but it's still at a big discount to its book value. And the dividend yield is about 6% as I'm recording this. So it's a great dividend stock with a lot of upside. And I'm a big fan of the banking industry in general right now. Truist looks like an especially good bargain. So I'm going to add that to existing bank positions, which already include Bank of America and Wells Fargo. Now, last but certainly not least, I have decided I want to own some PayPal shares again. PayPal's a stock I owned a while ago. I got shares as part of its spinoff from eBay. I used to be an eBay shareholder. And PayPal just looks, quite frankly, too cheap to ignore. It really hasn't rebounded like the rest of the market, even though the business seems to be doing very, very well. First quarter, we haven't heard second quarter results, but first quarter results are ahead of estimates. It did over $7 billion of revenue, generated $1 billion of free cash flow in the first quarter alone, about over $5 billion over the past 4 quarters. Big margins, very profitable business. The number of active accounts has dropped a little bit to 433 million, but mostly this was shedding, barely active accounts, I'd call them. The actual transaction volume is up 12% year over year. So PayPal users are using the platform more engaged. That translates to more fee income for the brand. Big stock buybacks. They're taking advantage of the current depressed market valuation. They spent over $4 billion in buybacks over the past 12 months. Venmo still has a lot of growth potential. Their branded checkout product is showing some serious traction. And the stock trades for about 12 times forward earnings right now. So that's one that I want to own. I think it's a very deep value stock right now and one that the market is really overlooking. Hopefully you enjoyed that. Let me know what you think of the 5 stocks I'm buying in August. Tell me what you're buying. I'd love to hear your comments, and I'll do my best to get back to each one of you individually. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.